Hello and welcome to CVS Intrinsic Valuation Analysis. This company actually surprised me because the company can be viewed as three businesses, or it has three business models. And selling medicine in their brick and mortar stores is only one of these three business models. The second surprising thing is that it has higher than usual risk, which makes the stock provides higher than usual return on investment. But before we go into all these details, please let me remind you that this video and analysis is not financial advice and it's for entertainment purposes only. To perform this analysis, we go over the annual report to learn more about the non-financial information like what is their business and what drives the revenue, and to learn more about the financial information because all the financial statements are included in the report. The annual report, or the 10K report, is available for anyone to download on the SEC website by using the ticker symbol of the company. And from this section, you can access all the annual and quarterly reports. So after downloading and going over the annual report for the past few years, I collected all the information that we need from all three financial statements. So CVS has one equity security or one class of stock with the ticker symbol CVS. The company reports its operation in a fiscal year that ends on December 31st. And the external auditor firm that audits the financial statements in 2021 provided a clean report. Or in other words, they are saying that investors can trust the financial statements. CVS has 5 reporting segments, but we will focus only on 3 because one is too small and the other one is the cancellation of revenue between the 3 segments that we are going to look at. Having more than one operating segment is not new for many of these big companies, but these segments are more of business segments that are independent and each has a different business model. I really thought before reading the annual report that CVS only sell medicine and other items through their brick and mortar stores, but they actually have other business models, and the newest of them is the healthcare segment. Yes, CVS provides health insurance plans for about 35 million people in 2021. And the reason that is their newest segment because it started in 2018 when CVS acquired Aetna Healthcare Company. The other surprising segment is the pharmacy services, or the pharmacy benefit management system. And to be honest, I didn't know what it is and I had to Google it to understand the purpose of this system. And simply, I thought that when I go to pick up my prescription from the pharmacy communicates with my health insurance plan, see if the medicine is covered, get approval to provide me the prescription, and gets paid by the insurance plan. But this obviously is not how it goes. There is a middleman between the patient, pharmacy, health insurance plan, and the drug manufacturer, and this middleman is supposed to optimize service and price value for a fee per prescription. But the funny thing, when we look at the revenue for this segment in 2021, it's about $153 billion, and it's the largest in all 3 segments. So in my opinion, maybe all these fees are actually making the healthcare system expensive in the United States. Finally, the third segment, which is the one that everyone is familiar with, is the retail segment that's about providing medicine to patients by fulfilling their subscriptions in their brick and mortar stores. Next thing, and as usual, we start by comparing the revenue year over year. We can see that the revenue is increasing every year, which is a good thing for this company. Moving on to see the expenses in every year compared to the revenue, we can see that the cost of revenue expense item is almost mimicking the revenue, which is a very good thing for the company. But it seems to me that it's too high, which tells me that their profit margins are kinda thin, so they have to rely on volume. Also, the operating costs are growing naturally, so it seems that the management is doing a good job keeping these 2 major expenses under control. Scrolling down to the free cash flow, we can say that the free cash flow is growing year over year, which is a very good thing, but the free cash flow to the revenue ratio is the lowest that we have seen, which is about 5%. In other words, for every dollar of revenue CVS had in 2021, only 5 cents were real profit and distributable to the shareholders. So in my opinion, 5% in free cash flow to revenue ratio is the first concerning matter. Moving on to the debt, we can see that there was a big jump in 2018 because, as we said earlier, CVS bought Aetna in 2018. But the debt to assets ratio is decreasing every year after that, and in 2021, the debt is only 24%, while in 2018 it was 43% of total assets. But it seems that CVS is not having any easy time servicing their debt because the times interest earned ratio is only 7 in 2021, which is the minimum acceptable ratio if you want to say that the company is solvent. And in my opinion, this is the second concerning thing about CVS. But to CVS credit, it seems that this ratio is getting better since 2018 because, as we said earlier, the company is reducing their debt slowly, and I hope they continue doing that. Moving on to the outstanding shares, there is a minor increase every year that's probably for stock compensations, but it had a big jump in 2018 that could be justified to buy Aetna Healthcare Company. So the company is not buying back its shares, which is not concerning because they are focusing on reducing the debt. There is a good news for dividend investors. CVS is a dividend company, and for the past 3 years, they distributed $2 per share, which is about 2% yield. Now let's move on to the forecast part. The first step of any forecast is to forecast revenue, which is a very challenging thing when the company has 3 different business models, because we need to find what drives the growth of the revenue for each business model. The green cells are the historical data, and the blue ones are the forecasted numbers. And after spending a good time reading the information provided about each segment in the annual report, I realized that revenue depends on the number of plan members and the revenue per each plan member for the healthcare segment. And for the other 2 segments, the revenue depends on the number of prescriptions and the revenue per each prescription. All these numbers in this sheet are in millions. So for example, the healthcare segment had 37 million members, but it went down to 34, and now it's increasing by 1 million plan member every year. So in my opinion, it is possible that 2022 will witness an increase of another million plan member. And the revenue per plan member is also increasing every year, and I assume it will only increase by $100 per plan member, which will give us about $88 billion in revenue for this segment. The same concept for the other 2 segments. The number of prescriptions is increasing by 100 million prescriptions per year since 2015, which will give us about 2,300 million prescriptions for the pharmacy services or the pharmacy benefit management system segment, and will give us 1,700 million prescriptions in 2022 for the retail segment, which is the segment that fulfills patients' prescription in the brick-and-mortar stores. Also, for the revenue per prescription, we are conservative in our forecast and assume no growth from prior year numbers. This will give us about $161 and about $107 billion in revenue for the other 2 segments. And by that, we forecasted 2022 revenue. Now we need to know how much of that revenue will be free cash flow. So we will use the free cash flow to revenue ratio that we have over here. To be conservative, we should use the same as prior year ratio, which is 5%. Next, we need to forecast the free cash flow per share, and for that, we need to forecast the outstanding shares. As we see here, there's a small increase every year, so in my opinion, 2022 will only have about 1.5 million more shares compared to 2021. Finally, we will start with a 5% return on investment, and we will not use a discount rate because we are recording this video a few days before the company's year end. Something to keep in mind that the return on investment ratio is a number that you decide as an individual investor. Now, after finding these forecast keys, we can easily find the intrinsic value of CVS stock. So in my opinion, these 4 keys will give us about $311 billion in revenue and almost $17 billion in total free cash flow, which means $12.76 free cash flow per share. Using 5% return on investment will make the stock appears to be very cheap, but we should not use 5% because we had 2 concerns in this valuation, which is the free cash flow to revenue ratio is very low at 5%, and the times interest earned ratio equals to 7 times, which is very low as well. These 2 concerns make many people feel that CVS might not be around in the next 10 years. So we have to have a higher return on investment to return as much as possible of our investment in the shortest amount of time. So if we say that we want to return all of our investment in 5 years, then we should have 20% return on investment, and that will make the intrinsic value of CVS stock about $63. But if we want to return all of our investment in 7 years, then we should use about 14% return on investment, and that will give us about $91 intrinsic value for the stock. In my opinion, I think 14% return on investment is a very good return, and CVS will be around in the next 7 years, given that they are reducing their debt every year. And once the debt is at the level that will take CVS out of this high-risk zone, the stock price will probably adjust to provide only 5% return on investment as many other mature companies, which means a potential huge growth in the stock price. This is it for this video. It truly means a lot to me if you consider supporting this channel by subscribing and liking this video. And please let me know if you have any stock in mind that you want me to prepare an analysis for.